I want to tell you something most people only understand after it is too late. The last time oil behaved like this, it did not just shake the stock market. It did not just scare traders on television. It quietly reached into the kitchen, the gas tank, the grocery cart, the airplane seat, the fertilizer bill, the trucking lane, the credit card statement, and finally the family budget. By the time the average person realized what had happened, the middle class was already bleeding from 10 places at once. That is why I never look at an oil shock as a commodity story. I look at it as a character test. I look at it as an ownership test. I look at it as a stress test for every weak promise in the economy. And when I see oil move like this again, I do not ask one question. I ask three. How fast will it raise the cost of ordinary life? How hard will it hit confidence before it hits the data? And who will own more of the future when frightened people start throwing assets away? That is the real game. People keep saying the war in the Middle East shook markets. That is true, but it is still too polite. What it really did was remind the world that modern prosperity sits on a fuel line. You can dress up the economy with apps, algorithms, cloud software, artificial intelligence, sleek branding, and clever analysts. But if energy gets expensive enough, all that elegance gets dragged back to the dirt. Trucks still move goods. Planes still burn fuel. Farms still need fertilizer. Consumers still pay at the pump before they do almost anything else. And when that pump starts taking bigger bites out of a paycheck, the rest of the economy starts bargaining with reality. The source document frames the current setup as a severe oil shock with a direct recession risk, especially if the conflict lasts and higher prices keep acting like a tax on everything people buy. File site turn 12file0 I have lived long enough to watch smart people repeat the same mistake in different clothing. They think the danger begins when the recession is officially declared. It does not. The danger begins earlier, when ordinary families start editing their lives in small, humiliating ways. One less trip, one delayed repair, one smaller cart at the grocery store, one decision not to replace the car, one family that decides not to move, one business owner who says, let me wait a quarter before I hire, one manager who says, let me cut 3 people and make the rest work harder. That is how middle classes get wounded, not in one dramatic instant. In 1,000 quiet adjustments, if you want to understand why this matters, history gives you a better education than headlines do. I remember how people talk about market declines as if they arrive from nowhere, like lightning from a clear sky. Most of the time, they do not. They announce themselves in the language of pressure in the last half-century. Major oil shocks showed up again and again right before or alongside serious economic pain. The source document points to 1973, 1979, 1990, and 2008 as oil shocks that led into recession, with 2022 as the exception, because the spike was brief rather than prolonged. Fay turn 12file0 that exception is more important than people realize. It tells you the market can survive a spike. What it struggles to survive is duration. A sharp pain is one thing, an expensive habit is another. If fuel jumps for 2 weeks, people grumble and move on. If it stays high for months, it starts rewriting behavior. And once behavior changes, earnings change. Once earnings change, hiring changes. Once hiring changes, confidence changes. Once confidence changes, asset prices stop looking like facts and start looking like opinions. That is why I do not waste time arguing about whether oil is an inflation story, a war story, or a consumer story. It is all three. And if it lingers, it becomes a class story. The middle class is always the first group told not to worry, and the last group allowed to reprice its life. The rich own assets. The poor often receive some form of direct support or adjustment, though never enough. The middle class owns obligations, mortgages, car payments, tuition payments, insurance, commutes, childcare, credit cards, subscription lives, deferred maintenance, retirement contributions. A rising oil price does not merely make those people angry, it makes them fragile. That is a very different thing. The average person thinks of oil as gas at the pump. I think of oil as the invisible toll booth on civilization. The source document makes the same core point in simpler language. Higher oil prices raise the cost of gas, diesel, shipping, groceries, travel, and fertilizer, which means life gets more expensive across the board. Fay turn 12file0 when you understand that. You stop asking the childish question of whether an oil shock matters. You start asking where it will show up first. It will show up in the cheapest places in life before it shows up in the fanciest. A gallon, a grocery run, a delivery charge, a budget airline ticket, a family vacation that gets postponed, a contractor who raises his bid, a restaurant check that no longer looks harmless. You see, inflation is never just arithmetic, it is emotional wear and tear. A nation can tolerate expensive things. What it cannot tolerate for long is expensive basics. That is the first mechanism. I call it the everywhere tax. No Congress votes on it. No president signs it. No one sends you an official notice. It simply arrives in every receipt. When oil stays high, the economy behaves as though a hidden tax collector has been inserted into daily life. Every producer pays more, every transporter pays more, every consumer eventually pays more, and the middle class pays most painfully because its spending is already committed before its decisions are made. This is why I say the middle class does not get wiped out by a market headline. It gets softened up by a cost structure. Now let me make it even harder, because 2026 is not just an oil story. It is an oil story landing on top of a labor story. That is what gives this moment teeth. If all we had was expensive energy, the economy might still bend without breaking. People would hate it, earnings would compress, but labor could stay somewhat stable. The problem is that labor is already unstable. The source document argues that artificial intelligence was already reshuffling jobs before this oil shock hit, citing high-profile layoffs and a broader shift away from entry-level button, pushing work toward leaner staffing and more AI oversight. File cite turn 12 file 0 that matters because one shock hits prices and the other hits confidence. One shock tells you life costs more. The other tells you your paycheck may be less secure. That combination is poison. A family can tolerate uncertainty if money is steady. A family can tolerate higher costs if the job feels safe. But when both move in the wrong direction at once, behavior changes fast. I call that second mechanism the paycheck squeeze. The paycheck squeeze is not just about losing a job. It is about fearing you could lose one. It is about not knowing whether the next raise is coming. It is about feeling replaceable in a moment when basics are becoming less affordable. The source document explains this clearly. High oil prices reduce spending power. Weaker spending hurts business revenue. Weaker business revenue hurts hiring. And AI is simultaneously leading firms to need fewer workers for routine tasks. File cite turn 12 file 0 that is not a normal slowdown. That is pressure from both sides. The household budget gets attacked from the expense side and the income side at the same time. I have always found that what breaks people financially is not one bad number. It is a bad spread. Expenses up, confidence down, income uncertain, borrowing expensive, assets volatile. That spread creates surrender. And surrender is where big transfers of wealth begin. Most people do not understand that recessions are not just periods of shrinking output. They are periods when weak hands are taught what they really own. Some own a paycheck they thought was permanent. Some own a house they thought was liquid. Some own stocks they thought they had the stomach to hold. Some own businesses that looked resilient only because fuel was cheap and capital was easy. In every cycle, the story changes. The transfer does not. That is why I focus so much on psychology. The third mechanism is the confidence trap. The source document says consumer sentiment has fallen to its lowest levels in 2026, and note something that many people never learn. Spending depends not just on money in the bank, but on how secure people feel about future credit and future income. File cite turn 12 file 0 that may sound soft to a person who prefers formulas. It is not soft, it is hard economics disguised as mood. A family does not buy a house when it fears layoffs. A driver does not replace a car when fuel feels unstable. A couple does not book a trip when prices jump and headlines darken. A small business does not expand when customers look nervous. Confidence is not a side note to the economy. Confidence is gasoline for spending. Take it away and the engine still runs, but not for long. This is where many analysts become useless. They wait for official data to validate what behavior already knows. They want GDP. They want formal recession language. They want committees and labels and backward-looking certainty. The source document warns against this lag explicitly, noting that GDP data arrives well after the behavior that causes it and that recession declarations trail the lived experience by months. File cite turn 12 file 0 I call that fourth mechanism the lagging mirror. The lagging mirror is what fools the middle class every cycle. People say the recession has not been declared, so maybe we are fine. People say the data is mixed. People say maybe the second half will improve. People say the market is up today, so perhaps the danger was exaggerated. And then 6 months later, they discover that the damage began when they were waiting for proof. I do not invest that way. I do not build my life that way. I prefer to notice the pressure before it gets a formal name. That does not mean I panic. It means I prepare. There is a very large difference between those two things. Panic sells good assets to solve bad emotions. Preparation builds cash, conviction, and room to act. This is where people often expect me to say that because the environment is dangerous, you should hide. I do not believe that. I believe danger changes price. And when price changes enough, opportunity appears. But only for people who are emotionally solvent. That phrase matters more than most balance sheets. You can be cash rich and emotionally bankrupt. You can have a portfolio and no discipline. You can own assets and still behave like a renter in your own financial life. The source document eventually moves from recession risk to long-term investing and says something very important underneath all the examples. If you believe the economy will be larger 10 or 20 years from now, downturns are not just pain, they are discounts. It frames recessions and market crashes as the periods that create new millionaires because strong assets can be bought at weaker prices. Fay file a site, Fay turn 12 file 0 Fay. That does not mean every falling thing is a bargain. It means fear throws good things into the same bin as bad things. And that is where a serious investor earns his keep. I have spent my life trying to distinguish between a temporary markdown and a permanent impairment. Oil shocks complicate that work because they do not just hit one industry. They scramble the discount rate in people's heads. They make everything feel suspect. And when everything feels suspect, broad selling begins. That is why I teach a very simple discipline. Do not build your future around the prediction of the next week. Build it around ownership of what still matters after the next decade. That sounds obvious until your account turns red. Then it sounds impossible. But this is where the identity flip happens. Most people think their job is to avoid feeling stupid during a crisis. That is not your job. Your job is to act like an owner when renters are screaming. Your job is to understand that volatility is the price of admission for buying pieces of a future that other people briefly stop believing. In the source document, that owner behavior gets described through a plain phrase, always be buying. The idea is not to guess the bottom. The idea is to keep buying broad assets regularly and buy more aggressively when fear gives you lower prices. Fay file site Fay turn 12 file 0 Fay. I would put it differently. I would say this: always be owning more of what panic cannot permanently destroy. That becomes the fifth mechanism. I call it the ownership test. An oil shock puts every household, every manager, every investor, and every institution through an ownership test. If prices stay high, do you own cash flow or just opinions? If jobs soften, do you own skills or just job titles? If confidence breaks, do you own discipline or just slogans? If markets fall, do you own businesses through diversified vehicles, or did you only own enthusiasm in a bull market? That is the test. Now let us get practical, because theory without protocol is entertainment. If I were speaking to a family, not a television audience, I would say this: first, stop lying to yourself about fragility. If your monthly life is already tight, an oil shock is not a macro event, it is a personal event. You do not solve that with philosophy, you solve it with margin. Build breathing room. Reduce the expenses that masquerade as identity. Do not add debt to prove stability in an unstable period. Do not finance ego at high interest while basic costs are rising. Do not assume next quarter will rescue a weak structure. Second, separate what you need from what you want to own. You may need a house to live in, you do not need to worship its market value. You may need a portfolio, you do not need to check it every hour. You may want gold, but understand why the source document treats gold as a hedge rather than a productive engine, useful more as insurance against inflation, war, and fear than as a long-term compounding machine. Fay file a site. Fay turn 11 file 17. Fay. That is roughly how I think about it. Gold does not wake up every day trying to earn you more money. A good business does. So I would never confuse insurance with an engine. Own insurance in the amount that helps you sleep. Own engines in the amount that builds your future. Third, understand the hierarchy of resilience. Some assets are claim checks on broad productivity. Some are claims on consumer staples that people keep buying even in ugly periods. Some are claims on energy if you believe fuel stays structurally tight. Some are claims on long-term technological build-out if you believe the future still requires more chips, more infrastructure, more intelligence, and more data. The source document gives examples in exactly those buckets, moving from broad market exposure to dividend and consumer staple exposure, then to hedges like gold, and finally to narrower areas such as energy and AI-related funds for investors who want more targeted risk. Fay file a site Fay turn 12 file 0 Fay. I am not here to hand you a shopping list. I am here to hand you an operating system. That operating system is simple: own broad productivity, own cash flow, own some defense, own optionality. Keep liquidity so fear becomes an opportunity instead of a prison. Do not make heroic bets because a headline made you feel prophetic. That is how amateurs turn a correct worry into a costly mistake. Fourth, remember that an oil shock does not only punish consumption, it reprices leverage. That matters enormously. A business that was viable with cheap energy and easy money may look very different with expensive inputs and careful customers. A household that could once carry a big mortgage, a car payment, revolving debt, and lifestyle inflation may suddenly discover that none of those obligations can be renegotiated at the speed of a commodity spike. That is why I say the middle class gets wiped out when living costs become faster than adjustment speed. The wealthy can reprice. The poor can sometimes pause. The middle class stays in motion and pays retail for delay. If you want not to be in that group psychologically, then you must behave differently before you are forced to behave differently. This is why I distrust the modern habit of building a life with zero slack. No slack in schedule, no slack in budget, no slack in debt, no slack in skill, no slack in portfolio concentration, no slack in emotional control. That sort of life looks efficient in a stable world. It looks foolish in a real one. Fifth, keep your eyes on the interaction, not just the event. Many people will spend the next year arguing about whether oil itself causes recessions. That is a schoolroom argument. The real world is messier. Oil interacts with confidence. Confidence interacts with hiring. Hiring interacts with spending. Spending interacts with GDP. GDP interacts with headlines. Headlines interact with markets. Markets interact with the willingness of ordinary people to take risk. The source document makes this chain visible by connecting higher oil prices to lower spending power, lower business revenue, weaker hiring, falling consumer sentiment, slower GDP growth, and then to possible recession conditions if that weakness persists long enough. Phaephilosite, Phay turn 12 file 0 Phay, that chain is what you must watch. Not because you can predict every link, but because once you understand the chain, you stop being surprised by consequences that were always implied. I want to say something else that people do not always enjoy hearing. A recession does not have to be officially declared for the middle class to live, like it is already here. If your grocery bill is up, your fuel bill is up, your insurance is up, your confidence is down. Your hours are uncertain, and your portfolio is volatile. Then your lived economy is already weaker, whether a textbook confirms it or not. That is why so many respectable-looking macro debates feel detached from ordinary life. The numbers arrive late, the pressure arrives on time. Now, I am a buyer of productive assets, not a worshiper of forecasts. So let me tell you how I think in a period like this. I do not try to predict the exact date when pain becomes official. I assume the next few quarters may stay confusing. I assume sentiment may remain weak. I assume markets may react irrationally to both good news and bad news, because markets do that all the time. The source document says this plainly. Stocks do not move in a straight moral line with headlines, and what matters is building wealth despite the noise rather than imagining markets will behave neatly. Phaephilosite, Phay turn 12 file 0 Phay from there. I build my blueprint. My blueprint in a period like this has 7 parts. I keep more humility than certainty. I refuse to let headlines rush me into concentrated bets. I keep adding to broad productive assets on a schedule. I buy more aggressively when good assets are marked down for emotional reasons. I keep a portion of the portfolio in defensive exposures so that I do not feel forced to sell what compounds. I study the areas where stress is creating future pricing power, and I make sure my household can survive an uglier year than consensus expects. That is the kind of protocol adults use. Children ask whether the recession has officially started. Adults ask whether their system can survive one. Children ask which headline will move markets tomorrow. Adults ask what they want to own more of if markets give them a better price. Children ask whether this time is scary. Adults ask whether fear is finally making quality cheaper. If you internalize that identity flip, oil shocks stop being only threats. They become sorting machines. They sort the fragile from the prepared. They sort the speculator from the investor. They sort the person who needs calm markets to behave from the person who can behave, even when markets lose their mind. In the source document, that last part is wrapped in a simple investor lesson about buying strong exposures when the market offers discounts and not confusing daily chaos with long-term direction. Phaephilosite, Phay turn 12 file 0 Phay. I agree with the spirit of it. But I would put it further. The biggest wealth event in a cycle like this is not the decline itself. It is the moment an investor decides whether he is still willing to think in decades while the crowd has collapsed into days. That is where fortunes separate. That is where middle-class anxiety either becomes permanent lifestyle retreat or temporary emotional discomfort on the way to ownership. And because I am speaking plainly, let me say the hard part. Some people will use this period to become richer, not because they are evil, not because they enjoy hardship, because they prepared cash temperament and structure before the crowd needed those things. That is how it always works. The world does not reward panic evenly. It rewards preparation disproportionately. So do not waste this period trying to sound informed at dinner. Use it to become structurally stronger. Use it to fix your debt stack. Use it to identify which expenses are truly essential. Use it to upgrade your thinking from consumption to ownership. Use it to choose the businesses, funds, cash flow streams, and defensive allocations you actually want before the sale becomes emotionally hard. And if the conflict cools, if oil falls, if the scare fades, good, then you lose nothing by having become more disciplined. But if the shock lasts, if jobs get softer, if confidence weakens further, spending rolls over, then the people who acted early will not need bravery later. That is the whole point. I am often asked when the best time to build a serious investment life is. The honest answer is before you feel safe, because once everyone feels safe, prices usually reflect it. The bargains do not come when comfort is abundant. They come when the future feels politically noisy, economically confusing, and personally unfair. That is when ownership gets mispriced. That is when the middle class is tempted to freeze. That is when the disciplined buyer quietly moves. So here is my final test for you. Do not tell me what you think oil will do next month. Do not tell me what some economist said on television. Do not tell me whether the recession committee will say the magic word in August or September. Tell me this instead. If everyday life keeps getting more expensive for 6 more months, is your household built to absorb it? If markets drop while headlines grow darker, do you know what you want to buy? If your industry uses AI to reduce the value of routine work, are you becoming more useful or more replaceable? If confidence breaks around you, do you become a seller of quality or a buyer of it? That is the contract, that is the threshold. Because the last time oil did this, it did not wipe out the middle class all at once. It wiped out the illusion that you could consume like an owner while living like a renter. And if this is happening again, the winners will not be the people who guessed every headline, right? They will be the people who built a life, a portfolio, and a temperament that can survive expensive energy, weak confidence, labor upheaval, and market fear without surrendering ownership. In my experience, that is the real dividing line in American wealth, not income, not intelligence, not even timing, ownership under pressure. Most people lose it. A few people expand it. Decide now which side of that line you intend to stand on.